Hey everyone, welcome back to Corporate Decoder, the place where we help you understand if a company is hiding something or just having a really rough quarter. Today we're dissecting a filing from Atossa Therapeutics Incorporated, and let's just say they're looking to shake things up, maybe even to the tune of a do-over. So what is the big deal? Atossa Therapeutics is calling for a special meeting of its stockholders to vote on potentially shrinking the number of its outstanding shares through something called a reverse stock split. They're hoping this will boost their stock price and keep them listed on a major stock exchange. Let's dive in and see what this really means for investors. First off, they're holding a special meeting virtually on the 20th of January 2026. You need to register by the 18th of January to attend, so mark your calendars if you are a shareholder. The main reason for this meeting is Proposal 1, which is to approve an amendment to their Certificate of Incorporation. This amendment would allow them to do a reverse stock split, ranging anywhere from 5 for 1 to 20 for 1. In simpler terms, they could combine every 5 to 20 shares you own into just one share. They're also asking for approval to adjourn the meeting if they don't get enough votes for Proposal 1, which is Proposal 2. Now, why on earth would a company want to do this? Well, the primary reason is to try and get their stock price back above $1. You see, Atossa Therapeutics received a notice from Nasdaq in February of 2025 eyeing they were not in compliance with the minimum bid price rule. Nasdaq listing rule 5550A requires a stock to have a closing bid price of at least 1.00 for 30 consecutive business days. They were given some time to fix this, and in October of this year they actually saw their stock price go above that benchmark for a bit. However, Nasdaq decided to monitor them for another 10 days and the price dipped again. As of December 19, 2025, the stock was trading at 0.70 yuan, and if they don't get it above 1.00 yuan by February 17, 2026, they faced delisting. The company believes that being delisted from Nasdaq would be a disaster. It could make it much harder to raise money, impact how easily investors can trade their shares, and hurt the overall value and liquidity of the stock. They also think that a higher stock price might make their shares more attractive to institutional investors and funds, many of whom have rules against investing in low price stocks. Plus, they suggest a higher stock price could decrease the risk of market manipulation, which they believe is more likely when their stock trades below $1. But, and this is a big but, a reverse stock split isn't a magic bullet. The company itself warns that there is no guarantee this will actually solve their problem. The stock price might not go up proportionally to the shares being consolidated, meaning their overall market value could shrink. And even if they do the split, the stock price could still fall due to other factors like their business performance or general market conditions. They also mentioned that a reverse split could actually decrease the liquidity of their stock, making it harder to trade, and might lead to more odd lots, which are smaller amounts of shares that can have higher transaction costs. Here is a tricky part: if you own shares and the reverse split results in you having a fraction of a share, they won't issue you that fraction. Instead, they'll pay you cash for it. This cash will be based on the closing price of their stock on the day before the split goes into effect, but they can adjust it after they pay you. You lose all rights to that fractional share. Let's look at some numbers to see the potential impact. As of the 1st of November, they had 350 million authorized shares, with about 129 million issued and outstanding. If they do a 5 for -1 split, the number of outstanding shares would drastically drop to around 25.8 million. The number of shares authorized but unissued and unreserved would jump significantly from about 187 million to over 317 million. This increase in authorized but unissued shares could, and they admit this, give them more flexibility for things like raising capital or providing equity incentives. But it could also be used to fend off a hostile takeover. Now for the tax talk, and don't worry, we'll keep this super simple. Generally, the reverse stock split itself is not expected to be a taxable event for most US shareholders. You won't owe taxes just because your shares are consolidated. However, that cash you might get for a fractional share, that is usually where the taxable event happens. You might recognize a capital gain or loss on that cash payment, depending on how long you held the original shares and what your basis in them was. If you held them for more than a year, it is likely long-term capital gain or loss. But here is the catch: they're not giving out tax advice, and you absolutely must talk to your own tax advisor to see how this affects your specific situation. Let's look at who owns what. As of the 1st of November 2025, Stephen C. Quaid, the chairman of the board, president, and chief executive officer, holds a significant chunk. He directly owns some shares, but he also has stock options that are exercisable within 60 days and some convertible preferred stock. When you add it all up, he is beneficially owning over 11.3 million shares, which is about 8.07% of the company. The entire group of current executive officers and directors together owns about 9.46%. It is interesting to note that as of this filing date, there is no single person or entity known to own more than 5% of the company's outstanding stock, apart from the management team as a group. This table shows the shares beneficially owned by key people. For example, Dr. Quay's almost 11.4 million shares represents 8.07% of the company. Another executive, Heather Rees, who recently stepped down as CFO, holds shares equivalent to 1.01%. Collectively, all 8 current executive officers and directors own a combined 13.5 million shares, making up 9.46% of the company. Back to the meeting details. If you are a record holder and want to vote online before the meeting, you can do so at a specific website until 11:59 p.m. Eastern Time on the 19th of January, 2026. If you are a beneficial holder, meaning your shares are held by a broker or bank, you need to get a legal proxy from them if you want to vote at the virtual meeting. Without that, your broker might vote your shares on routine matters, but not on the big proposals like the reverse stock split. This brings us to Proposal 2. It is basically a safety net. If they don't get enough votes to pass the reverse stock split, they want the option to postpone the meeting to try and get more yes votes. This is a common tactic when a company really needs a proposal to pass. So, what is the story here? Atossa Therapeutics is in a tough spot, and they're trying to use a reverse stock split as a lifeline to avoid delisting from NASDAQ. It's a move born out of necessity, not necessarily from a position of strength. The core problem is their low stock price, which signals a lack of investor confidence or perhaps concerns about the company's future prospects. While the reverse split can artificially boost the share price and satisfy listing requirements in the short term, it doesn't fix the underlying business issues that caused the low stock price in the first place. The risks are significant here. There is no guarantee the price will stay above $1, and they could end up delisted anyway. Plus, the reverse split could make their stock less liquid and more expensive to trade for small investors. The increase in authorized but unissued shares also gives management more room to maneuver, which could be good for future fundraising or acquisitions. But it also raises questions about potential dilution for existing shareholders down the line. Looking at the ownership, it is clear the executive team is heavily invested, which can be a good sign if they believe in the company's turnaround. However, their significant holdings also mean they have a lot to lose if the company continues to struggle. In conclusion, Atossa Therapeutics is trying to buy itself some time and avoid a serious setback. The reverse stock split is a tool, and like any tool, it can be used effectively or ineffectively. Its success will depend on whether it is accompanied by tangible improvements in the company's business operations and financial performance. Without that, this might just be a temporary fix. Alright, that is our breakdown of Atossa Therapeutics Incorporated's filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the conversation. Thanks for watching. See you next time.